I am coming today with my next topic, creating a timeline for your savings. So like I said, the timeline for your retirement savings is from the beginning when you start working to the end when you retire. You save from one to the other. That's my opinion. That's how retirement works. That's the retirement savings. The emergency fund savings is reaching your specific goal for your emergency fund. Once you reach that specific goal, then you're good there. The home, the car, the vacation, the college, all those are timeline goals that you set a timeline, you set an amount, you set a goal, and you think about it. All of these things require research. You need to understand how within these savings goals, what vehicle you should be using for them, which is something that we're going to talk about also. So you want to make sure that you set a timeline. If it's a vacation goal, you want to make sure that you have which vacation you're going to, you've budgeted for that vacation, and you want to make sure that you're doing that. The other things you need to do is you need to use the right saving tools. You should also use the right type of savings account for your goals. So this is where we're talking about the vehicle that you need to use. If you're looking to save money for longer than 5 years, you should consider mutual funds. The stock market on average, of course, it goes up and down. So that's why we talk about the stock market as long-term goals. We're not day traders here. We're not looking at it every day. We're looking at long-term goals. So if your long-term savings goal is more than 5 years, consider your risk level and consider savings in mutual funds. There's also high yield savings account. Interest rate is higher now, so this is something that you might want to consider. There's also money market funds that you could do. Credit unions have really good rate on money market funds, so you should definitely think of that, or CDs. Those are type of things that you should be thinking about depending on your goal, your savings goal. Definitely, you're in your retirement fund. It should be based on two things. Of course, you consult your financial advisor for help on this. I am a certified public accountant. I'm not a CFP, so I always defer to the expert in that specific field and ask that person the right questions. When you're working with your finances, it's not one person that you work with. It's you having the knowledge to hire the right people around you, to have the right advice that comes in. And then you take from all the different areas and you make, good decisions with that. So definitely talk to your financial advisor on your risk level is number one. Your age is number two when it comes to retirement, because that affects how aggressive you want to be. Because most of our retirement, we want to have it either in mutual funds, EFTs, which are exchange trading funds, equities, they historically garner larger returns regardless of the stock market and where it is. On the long run, it's between 10 and 15% growth. So that also should be, if you are younger, you start off riskier and then you move forward. As you move forward and you move closer to the dates where you're going to be taking money out, you want to be more conservative, because at that point you are being conservative. So if you have a combo of everything. So, you do not want to have your emergency fund in something that's locked in for a long time. So you want to consider where you want to put your emergency fund. And that's something that you want to have available. Your emergency fund is something that you want to be able to have available. Which savings vehicle you want to put your emergency fund in, so it will cover your monthly expenses if need be. So then our next thing on our savings goals is track your goals. Check and see how it's going. Okay. Look at your retirement once in a while. Probably not when the market is low, but remember, if you do not sell your funds, or you do not cash in your EFTs, or you do not, you are not losing until you realize the money. So anything that's in the stock market or in the housing market or anything like that, if you don't sell it, you are not losing on it until you realize your loss on it, just like you would realize your gain. Realize means it's coming back to you, and whatever it is, it comes back to you, that's it. So until you sell it, it's not realized. So you want to make sure that you're tracking your goals. You know what accounts you're putting your money in, which savings pots is for what. I mean, some of my savings accounts have names on them. It says vacation fund. It says college fund. It says, whatever it is. It says rental, So that's one of the things. So the other thing that I suggest is use technology to your advantage. One of the things is automatically transfer from your checking to your savings pot each month. Just like with the 401k, have the money come out before you even touch that money for your expenses. So I suggest that automatic transfers divvies it up. You don't have to think about it. You don't have to press a button. You don't have to do anything. You make your goals. You set your automatic transfer. You look at your stuff every time to make sure you're keeping within your lines of your goals, and you do the automatic transfer. So it's not something that you have to press a button. Sometimes it's like writing a check. Some people, it's really hard for them to write a check or, to do something, even though it's something good that they're doing and it's rewards coming back. It's just an emotional thing for them. So doing the automatic transfer takes the emotions out of it, so because digital apps will show you how to do all these things, help you separate out your savings, help you put your things in different pots, those type of things. One of the things that I want to talk about also is how do you keep within your goal and stay with your automatic transfer is one way to avoid overspending. We need to avoid overspending if we're going to be keeping with our goals. So you want to make sure that you use the 30-day rule. I try to use this 30-day rule. For Lent, it was 40-day, but I try to use this. Sometimes I go shopping, I'm window shopping, and I put stuff in my cart. Of course, my virtual cart. And then I think about it. I don't click and buy it right away. I'm like thinking about it. I eye the purchase. I look at it. Do I really need to make this? I put it in my shopping cart and I walk away. I leave it there. They'll send me emails because those retailers are smart. They know what I put in my cart. So they're going to say, oh, you still have time to buy that Jimmy Choo's from Saks. But by then I've thought about it and I'm like, okay, it was on sale, but do I really need another pair of shoes? So definitely it's something that you need to think about. If you want a shorter period for that, 30 days, think at least 48 hours or a week, whatever works for you, but don't impulse buy. Don't click right away. Think about it, talk about it, window shop on it. Because during Lent, I gave up shopping, but I didn't give up window shopping. And boy, have I been window shopping. But half of those stuff I forgot about already because I just, it fed my hunger for the minute. So I'll tell you that shopping is one of my, my shortcomings, if you would say. So that's definitely what we want to talk about is make sure that you do not impulse buy because you don't want to regret. One of the biggest issue that I see with especially rich people who make a lot of money, they impulse buy all the time because they want to keep up with the Joneses. And because they want to do that, they regret buying later. I see it all the time. They buy something super expensive because that's what everybody's doing. And then they're trying to budget their food bill. And they spend tens of thousands of dollars on something that they regret buying. So you don't want to have any regret buys. You want to make sure that you do not impulse buy. You think about what you want. Put it in your cart so you feel better about it, or you feed the hunger of whatever it is that you're doing. So and then think about it. Think about what you're doing. Is that one of your priorities? Make it that impulse buy part of your spending goals. Is If I buy this furniture right now, do I really need it, or can I keep this one for another time? I can use that money in my vacation fund. Would you rather do the vacation fund? You know, things like that. You always want to make sure that you split your stuff into, even when my husband and I was when we were starting out, starting our kids' college funds, you know, I would put $50, $75, whatever birthday money they would get into their 529. And then down here in Florida, we have Florida prepaid. I would make sure that we have them in their Florida prepaid. Now my one son is going to college without loans. So, you know, and a condo that he lives in, that is one of our saving spots. So that's one of the things that you need to look at. Do not impulse buy, because the reward of a well thought out buy it will give you hands down a lot more than your impulse buying. You want to make sure that if one of your pots, let's talk about a few savings pots that I believe in and that I have lived. So one is college funds. I believe that helping our kids with college education, understanding the cost of college education, which most of our college students do not understand. Their parents do not understand. They do not know how to compare the college cost to the degree, if it's marketable. If the child likes a certain area, you can pick a degree within that area that it's marketable for them. Have them try things out to see what they enjoy, what they like, what they don't like. We don't want to pick a degree just for the money, because we're not going to enjoy it. Trust me. Our main goal in life is to be content and happy. So we want to be able to do that within our means. We want to be able to do that without racking up student loans. We want to be able to do that, live a comfortable life. And the way that we do that is taking control of our money, making our savings goals, prioritizing what they are, be realistic about it. You know, yes, your child can go to Harvard or can go wherever they want in terms of a degree, but while you're looking at that school, part of when you're looking at that school is looking at, one, how much money have you saved up for that child for that school, what their financial package is going to look like, and how much loans are they going to end up with when they're done. And the next thing that you need to look at, the last thing you need to look at, is what is the average salary for the degrees that they're coming out with. Will they be able to pay back that loan? Because you can go to community college, or you can go to state college, or you can go to private college, or you can go to Ivy League. There's a vast difference on the cost of college. The thing about America, looking at it from a global perspective, is that I always say that you can get whatever you want here. You know, you can furnish your whole home. You can live comfortable in a small home. You can live. It's how you want to live, where you want to live, what kind of things you want to furnish that home with, what kind of home you want to live in. So some of us, when we're starting out, we have to realize that we're starting out. We start somewhere. You take what you get until you get what you want. If you wait for that dream home and you don't start with the starter home, you're not going to skip 5 steps and get that dream home unless you're winning the lotto somewhere, or you're going to be above your means. So when you start, I started with a condo. Then we moved into a small house. Now we moved into a bigger house. Now we're in a bigger house. So you move according to where your budget takes you. You move according to your means. So you start off with what you can get, and then you move. If you're renting all that time until you get to your dream house, you're never going to get to your dream house where it's a comfortable within your budget for you, because you want to be able to gain equity as the time goes by. So when you start off with your condo, you're going to have equity in there. when you decide you want to move up to the next level, or you're ready for the next level, or maybe you have kids and stuff like that, or whatever it is, then either you can sell your condo, take equity out of your condo, have money saved up from that because you're not paying the high rents. And because while you were living in your condo, you were paying down equity. If you lived there for 10 years and you got a conventional loan, part of your condo payment is a savings pot. You know, let's just say you're paying $1,000 in mortgage. At least at the beginning, you can start off with $150 as paying down equity. By the time 10 years goes through, maybe $300 is paying down equity. I'm not even counting the appreciation of the real estate market. I'm just counting it as a savings pot. When you make a mortgage payment, you pay principal. Principal is a savings pot. So it's a way to save. Whereas if you're paying $1,000 in rent, it goes to your landlord's mortgage, and they're the ones that's going to be paying down their principal, and they're the ones that's going to be able to make the money from you there. So if you make that sacrifice, and between rent and mortgage these days, it's not a huge thing if you are willing to take what you get at the beginning. You know, start small and move forward. You know, it's a building block. You do not start with your BMW, or you do not start right off college with a seven figure car, or you don't start off with a 7-figure house. You start small and you move forward. That's how people build wealth. It doesn't come automatically. It's a stepping stone. It's one block at a time. So you need to keep building your savings blocks, and there are ways to do that. One is your principal, your mortgage that you're paying down principal. That is a savings pot. That is one of the things that you're doing. After 30 years, if you live in that place for 30 years and you haven't taken any money out, you're done with your principal. Let's say you bought that condo for $200,000. I am sure with the way the real estate market goes, there's some appreciation. Let's say it only appreciated $100,000 in 1 year, which I doubt, in 30 years, which I doubt it. But in addition to the appreciation, you have paid off the mortgage, and you're paying off the mortgage by paying principal, and that is one of your savings spot. I bet most of us don't even think about it like that. So I want you to have that money mindset going, thinking of where your savings pots are, thinking of how you can reallocate your money, your finances, to meet these goals. You have to be proactive if you want to control your money. You have to be in there being proactive, understanding, looking, overviewing, so you don't overspend, and you're focused on what your goals are, and you're making gains on them, and you're pursuing them properly, and you can move on to your other financial goals. So you want to make sure that that you're doing all of that. Those are the things that you need to think about when you're thinking about these things, when it comes to savings. So you want to make sure you're thinking outside of the box. You want to make sure that you're thinking about building your wealth. When you first start out, you're starting out thinking of building wealth, because you just don't want to live within your means without moving forward in life. So you're living, you're learning, you're moving forward. You want to also make sure that you hire the right people to help you. Listen to the right people. I'm talking to you with 3 decades of experience in accounting, finance, tax. I used to balance my father's checkbook at 14 years old. So this is ingrained in me. I've been doing this for the longest time. I've had experience with many, many clients. I've had experience myself with trial and errors and situations. So I'm telling you from experience that all these things that we've talking about with our savings goals and our savings pots, they are achievable. I am living proof that they are. A girl who was 9 years old when she came with her dad to this country, and now, have built her wealth and continue to build her wealth. So That's our second topic, which is our savings goals and our savings plans and different avenues that we can save. We've gone over retirement, emergency fund, home fund, having you, in addition to the home fund, your principal pay down of your mortgage is also a savings pot. All the other things that you want to think about, that you want to prioritize. So you need to be active within your finance in order for you to be able to control it. Stop thinking that it's a taboo subject. This is part of your life. And if you keep working at it and do not think it's a taboo subject and work within that area, it's really not that hard. Again, this is Sherron, the Modern Savvy CPA. I would like for you to definitely subscribe, and follow me on all of my social media. And I will talk to you next time on our next topic, continuing our series on financial literacy. The information and views on this video is provided for specific subject matter only and does not reflect official opinion or position of the Modern Savvy CPA LLC or Sherron Permashwar CPA. The Modern Savvy CPA LLC or Sherron Permashwar CPA were not engaged in providing legal, tax, or accounting services. Before taking any action based on this information, we strongly encourage you to consult with a professional accounting or tax advisor about your specific situation.